Good day, traders. This is Mdlalose. I know I haven't posted videos for a few days now because I've been a little bit hectic, and I thought, let me just come back and look at a topic that I've never spoke about. And in fact, I've spoken about supply and demand, but I've never explained supply and demand in this particular angle that I'm going to be um, using today. So it's still supply and demand. We're still using supply and demand and volume, but the only difference is we are using supply and demand based on the market profile or based on the volume profile. Okay, so what is market profile? You can clearly see, guys, at the back here, this particular indicator right here, this is a market profile indicator. Maybe it's not that much clear. Maybe I might just change the color of this thing to let's see if it will allow me to. Looks like I cannot, but I'm okay with using it as it is because I can see what is happening. But yeah, this is the market profile indicator. This is also the market profile indicator, and that is the particular indicator that you need to be focusing on to actually identify supply and demand errors. Remember, when you are trading supply and demand, you basically are predicting what the markets will do. Yes, you're basically predicting what the markets will do, of which to predict the markets can be tricky than following the markets. I usually say follow the markets, do not predict, right? But there are other high probability trades that you can actually take from predicting what the markets do based on what the market has done. So that's where the difference is. You are not just predicting out of the thin air, you are predicting based on something that has happened in the past a few days, right? We all know in trading there's supply and demand, or other people can call it simple support and resistance, which is still also okay, but I prefer to call it supply and demand because it gives me weight. That weight gives me weight, supply and demand, so I'd like to use that, not support and resistance, although it's one and the same thing, right? So what I wanted to show you is the first thing that you need to do is to load the market profile indicator. There's tons of market profile indicators online, ladies and gentlemen. There's a lot. I mean, I'm using there's a lot. I'm using this particular one. There's this one, VA market profile probability. There's quite a lot of free market profile indicators if you go online. So just go pick any that you think you'll understand and simple to use, and just simple use that. But if you interested in this particular one that I use, please comment below and leave your email address, or comment below, and then what I'll do is maybe I can just attach it there. I don't know if there's an easier way for me to give it to you over the emails. So this particular trade, in fact, this particular currency pair is USD against the Japanese yen. This is the first example that I'm going to walk you through, guys, so that you can understand what I mean. So when we look at this, we can clearly see where the markets were mostly active today, right? Slightly here as well. So these are the three areas, 1, 2, 3, where the markets were mostly active. Yeah, we can also say this one as well. This one down here it was pretty active as well. You can clearly see 1, 2, 3, 4. These are the areas where the markets were very active today. If we go back to yesterday, we can come and identify this level as a level where the markets were very active, right? You can clearly see how pointy that finger is, and then from there the market just took off from that particular zone and started trending up. So the most important thing to understand is you let the markets move away from a zone, you let the markets move away from a level, and then you go back, right, and mark that zone as a possible bounce area in the future based on price action and based on market profile, which is your market volume where there was activity. So let me break down the market profile first before I go further so that you understand. So market profile shows you where there was activity in the market. It draws those levels for you and tell you there was market activity on this level and you need to be interested on this level. It's as simple as that. Market profile simple looks at the areas where the markets were very active, and then it draws that for you. So in this particular case, the simple thing to do is identify those zones. For example, this is my zone on USD JPY 110.05, right? So what another trick that you can do here, right? You can use a round number indicator. For me, I don't need it because I've been trading for a long time. It's one of those things that I can actually try to round off and do whatever. Let me see if I do have a round number indicator. Unfortunately, I don't have one right here, but I just wanted to put one and show you, but it's not that much important. But if you can, look at this number here, 110.05. To me, that's pretty much a round number, right? That's pretty much a round number, 110.05. So you can always look at that particular number and say 110.0, right? And then you make it a round number there because it's slightly closer to that, but to be correct, I'll move it up here to 110.05. Now, the only thing that you want as a trader is the price to come back to this level and find your order waiting for a buyer here already. Why? Because based on the history, based on what we've seen on the charts, we know very well there was serious activity at this particular zone and the market took off from that zone. It means buyers were in control from this zone and the trend continued and is still continuing. This particular zone tells us that it's a good demand area. I can even put a vertical line and you can clearly see even down here that particular zone. From there were high buying volumes. You can clearly see high buying volumes. It confirms whatever the market profile is telling us because we can already see that there were high buy volumes right there, so that you don't have to worry about a lot of things. So the first thing that you need to do every morning is to identify these zones. So this particular case, you have a line here, okay, of which here I'm not really that much worried about this law. Okay, what I would possibly do is make sure that my stop loss is not below this law. It's slightly under that law. Why? Because with high probability, if the market comes back here to test this demand zone, it might also want to take out the stop losses that are hiding below that law. So this is basically hitting two birds with one stone, because this particular zone tells you that when the market gets here, we are highly likely to buy, but still it's confirmed by this law again and say there might be stop losses hiding below here. So we have a high probability of the market coming and going a little bit below the zone, leaving a spike and going back up. But before it even comes down here, today already we have this zone and we have this particular zone as well, right? And we have this law. Okay, so you've got two odds working in your favor. Again, the very same concept. The market comes back to this particular zone to test this demand zone. It goes a little bit below to take out those stop losses, and then simple, it starts trending back up. Because if I were to say where the trend is going right now, or to look at the overall market sentiment, the market direction, the market is in an uptrend as confirmed by the bigger time frames like the 4-hour and the daily. Yes, the market is in the bigger time frames, but the market being in the bigger time long in the bigger time frames doesn't mean that there are no pullbacks and there are no retracement. So you need to be watching out for this particular zone. If it breaks this zone, you know with high probabilities coming back for this zone before, it has highly likely to go back up. But in this particular trend right now, it's too strong for it to get down there. Looks like it's way too strong to actually come down here. Here, yes, very much possible, but to come down here, yeah, it might, but the way you can view the trend, there's serious buyers behind this market right now. We don't know whether it's long-term buyers or it's short-term buyers, but the bottom line is there's strong buyers behind this particular market. So this is the first example on USD/JPY. If you were to round off and look at the levels, you could say right here 111 point, let's go down 0.20, 111.20. It's a little bit far from my level right there now. I don't like that. Right here, one. Okay, round it off to, let's say if you run it off to 30. Okay, it also gets a little bit higher, but 30 is fine. 111.29, which is close to 30, which is good enough. So you can put that as a demand zone. You can set your MetaTrader to alert you when the price gets there, so that even if you're on your cell phone, you get an alert and say the price is sitting at 111.30 and then you know that you are going to be buying. Your stop loss is going to be below these levels. Very, very important, because if you are buying here, the price hasn't really reached the current daily lows, right? And as we know, the daily lows, that's where people like to have their stop losses. Number one, this is a daily low, current daily low. Okay, this one right here. Number two is the newest swing point again. So we've got two odds working in this favor, that most of the people's stop losses are right on this level, and it's also a current daily low. That's why if you want to sell here, there's no way you can start selling when the price is actually down here, because you're asking for trouble. That's why you take a trade, your system said sell, and then you take a trade to read. In the markets where you take a trade, it goes your favor 2-3 pips, and then it goes shoot, shoots back up, and then it leaves a low test bar, and then you ask yourself, why did the market leave that low test bar? I am trapped into a trade and wara. It's mainly because you were buying closer to an interesting area. You are selling at the wrong place, because highly likely here, based on the history that we have seen, the market is highly likely to actually reverse at this particular area. Okay, now let's look at another example. So this was USD/JPY. Let's look at GBPUSD. Okay, let's look at GBPUSD, right? So if we look at GBPUSD, already I've identified the areas that are interesting for today's trades. All right, number one, for today, I would be focused on this level. I would be focusing on this level as well, and finally I'd be focusing on that level above there. But you can clearly see already what has happened. The market started on this level, pulled back down, came back up, pulled back down, went back to that level, the morning level right there, with this candle right there, before it was rejected and the market went down. So if I make this easy, you can clearly see this is how it went down. I will delete this one and delete this particular vertical line and leave the morning one. It means in the morning, the price left this zone and went down, right? But when it returned back into that particular zone, the market was pushed back down. Why was the market pushed back down? Because if you go back to the market profile, you can clearly see there was high volume there. Really not the highest volume, but there was serious market activity there that pushed the price down, and the market went back there to that zone and pushed it back down. So if you watched this video from the start, you'll understand that I said I don't want my stop loss to be right here. I want my stop loss to be above. Sometimes it happens that the market tests the zones right from the morning and doesn't take out the stop loss and continues to go back down. Sometimes it happens that it tests the zones and also pushes above a little bit just to take out the stop losses and go back down. Right, let's look at another example so that we can understand exactly what I'm saying right now. Perfect. Here's a perfect example of what I'm saying. Here's a serious activity in this particular market zone, right? And the market came back here, went back down, went back up. This is what I was talking about. This was the current daily high, right? This current daily high, the market goes back above the current daily high and started pushing back down, and then from there the rest is history, because the banks had already grabbed the stop losses. It was time for distribution, and the market continued to go back down. But you must be guided by this now. Even the following day, today, if the market takes out that, I would highly likely come here, okay, and have an order or look for my system to start showing me signs of going down. Why? Because I know here there was high activity, trading activity here, and the market from that high trading activity sold. It means there were sellers that were positioned here, and they managed to push the price back down, and the market goes back to that high activity areas that I know there were sellers. I'm highly likely looking for sellers to be still there or to come and defend this area because they don't want to lose money. But I would be very happy if the market comes and does this, checks out these sellers, goes above that high, right, and starts pushing them back down again. I'll have even more confidence, because it will say to me that the markets have actually taken out stop losses, and it is actually tested a high activity zone, or where there were a lot of traders that were positioned. So I'm very happy if the market comes even above that zone and then it starts pushing back down to give me sort of like a confidence in my trade. So market profile, ladies and gentlemen, is not that difficult to understand. It's not that difficult to understand. And lastly, I'll show you an example of GBPJPY. Let me go GBPJPY. Let's check out GBPJPY and see what is happening on GBPJPY. Let's delete this. Okay, right, this is GBPJPY. Just reload the template quickly. Okay, there we go. The market is actually going up right now. It's in a buying phase. But where did the buying start? This buying started here, around about here, 143.74. If I want to round it off, 143 point, let's see, not really 143 point, let's see if we can get, nah, I'm happy at 143.7 or somewhere around here, 7273. It's perfect right there. I'm happy for market to come down here, and then I'm looking for a buy, a backup. What I want to say is, sometimes the market doesn't bounce a lot of pips from this zone. It can be 10, 15, 20 pips, or it can bounce and go 100 pips. The bottom line is, this zone is highly likely to offer us support based on this morning's trading. It's highly likely to give us support. So if we look at yesterday, this is my zone from yesterday. Look at this finger. This is actually the highest market activity from the previous day, because if I do this, you clearly see that right here, if you look at other market activity zone, it wasn't really the greatest. So there's this one is number one, and highly likely this at the beginning of the day is number two. So if it breaks this zone, if it starts trading below, I would be waiting for the market right on this zone right here. Better if it comes below the zone a little bit, and then we start going to the upside. So how do you actually trade this? How do you execute a trade on this? There's two ways, ladies and gentlemen. Number one, what I suggest you do is you put in an order on this zone. right? You put in an order, a buy stop, okay, a buy stop right here, so that when the market comes here and it touches the zone, sometimes it touches the zone and quickly reverses and you're in profit right away. Or you can physically wait and watch price action when it gets here, so that when the market comes here and it leaves a spike, then you start looking for confirmation to the upside, make you look for your volumes to be buyers volumes or whatever, maybe round about up there, then you start buying. That is a much better trade to wait for the markets to tell you, but a little bit riskier, because if you put a buy order here and it touches the zone and moves right away, you are highly likely to be in profit within a few minutes, which is very good for you as a trader. So also again, when the market comes here, you can start put your order here, and then your stop losses has to be way below this particular low, because already as I'm speaking to you right now, this particular zone, there are stop losses. So here essentially you're using two techniques. We are using supply and demand together with market maker trading style. What do I mean by that? Is supply and demand is identifying where the big guys were buying and selling. But also market maker, in terms of the stop hands, you understand where the big guys or the big traders are highly likely to push the price in order to trigger stop losses, right, before the market reverses as well. So that's very, very important to understand. So in this particular zone, you'll be looking at this particular level, stop loss below right there, so that if it taps the stop losses, you are safe, and we are looking to be in a buying side of the markets, right? It's as simple as that. You can download the market profile and go and look at tons of examples. You'll understand exactly how it works. It's not rocket science. It's not that difficult. Let me show you my last example. You can clearly see this was a high market zone. There was a lot of activity. The market pushed back down as indicated here, and then also the market for the rest of the day and the following day it pushed back down. That's why when the market went back there to that particular zone, it failed to break the zone and it started pushing back down. Yes, because that zone, we know that's where the seller was originated, or these sellers was originated. This is where sellers started being in control from this particular zone, and we know it's highly likely to play a part in the future. I prefer for you to look at roughly maximum 3 to 5 days of market profile. Anything after 5 days is a little bit, it's not that strong, but this is day number 1, this is day number 2, this is day number 3, this is day number 4, this is day number 5. To me, that's good enough, because the more I go to number 6, yes, it's still good enough, but remember, the interest is now old history. People are losing interest in that particular time, but people can hold a trade for 2 to 3 days. Does that make sense? So you need to understand that looking at least from 3 to 5 days, that's good enough. You can stretch it to 6 days, but 3 to 5 days is good enough. Ladies and gentlemen, I took a lot of time to plan this video for you. I want you to watch this video and finish and take notes, and if you're not really clear, you go back and rewatch the video and comment below so that I can see if I can send you the indicator that I'm using here, the market profile indicator, because that's the trade. This particular trading style is based on the market profile indicator. As I always say, please share this video with your friends, share with your cousin, share with your mentor. Also subscribe and make sure that your bell icon is on, so that when I post a video, you are the first one to watch my video. Mdlalose, stay blessed and happy trading, happy peeping. Bye.